We ended the week very positively in the S&P, green nearly right across the board, breaking towards all-time highs once again. However, we do have to be cautious given that the S&P P ratio does sit around 31. Bear in mind that the average in the modern era time does sit around 20, so you could argue there needs to be some caution when picking stocks for the portfolio. That is why in today's episode we are looking at 7 deeply discounted stocks that we believe have a good position in the portfolio for long-term growth. We believe they have margin of safety looking very good, as well as the upside. As always, we'll run through each one of these companies. We'll talk about their earnings projections in the past, as well as the growth moving forwards that is anticipated by management. We'll talk about their dividend safety, running through some metrics that includes dividend yield theory, comparing their forward P against the 5-year average. And as always, we want to highlight whether or not these companies are high quality. Looking at their free cash flow metrics, we're going to run through their ROICs, their debt levels, and much more. As always, we are going to run each one through the valuation model, getting to our intrinsic value, discussing what percentage of an MOS we see, 10, 20, 30, 40%, and also talk about the upside that Wall Street believe each one of these companies have. Some of them are very, very high. Now, before we do jump straight in, there are a few things that we want to consider. As we mentioned, PE for the S&P does look very high, and it does seem to be good news for investors that are fully invested. 2024 is looking to be one of the best years over the last 20 years. As we can see right now, your overall gain would be around 25-26%, but we do have one final month before we do close out the year, and as we can see here, it could possibly enter the Hall of Fame in terms of S&P 500 index gains. We also notice in terms of the fear and greed, the market sentiment right now is sitting firmly within this position at 66 points. It does seem quite a longer way now that we were sitting in neutral or fear. Just something to bear in mind, but ultimately that shouldn't shape your investment decisions. And finally, we just want to highlight earnings season has started to quiet down, although there are some notable companies that are reporting their earnings next week. For example, we have Salesforce after the market close on Tuesday, as well as Ulta Beauty, UiPath, and Lululemon reporting after the market close on Thursday. Do give us your thoughts if there are any of these companies that you do want us to keep an eye on and possibly review once they've reported. Now let's jump straight into the first company. It is Northrop Grumman Corporation. Now interestingly, not something we see often. Quant have given this a strong buy, both Seeking Alpha and Wall Street also with the buy rating. So that looks very positive, off to a good start. Right now, this company is sitting at the midpoint of the 52-week range with a forward yield 1.68% and a forward P around 18.8. In terms of the performance over the last year, it is up around 5%, so it has underperformed the S&P 500, but when we do zoom out to over the last 10 years, up 231 and outperforms. Then when we take a look at the earnings, as we said, we'll look at these for each one. Out of the next 4 quarters, they do anticipate 3 of them to be positive growth to the EPS year on year. And when we do zoom out over the previous 4, they've actually got a very strong track record, 100%, 4 out of 4 beats, and each one is very sizable in terms of the increase to the EPS from what the market expected. And in terms of moving over the next 4-year accounts, EPS of 28 is anticipated to lower the forward P to 17.45. Now, in terms of the metrics, first one, dividend safety score 90, very safe. We love to see that on this channel. We'll cover these 2 valuations shortly. And another thing we love to see here is a double-digit increase to the dividend. In fact, 10% in May was what they released. In terms of dividend safety score, well, as we said, very safe. It was reaffirmed just a few weeks ago, and this ultimately means for NOC, a dividend cut is highly unlikely. Now, key metrics, this is effectively how they performed in the 07-09 recession. They increased the dividend. They had average growth around negative 14%, but pretty much a spot-on S&P return of negative 55. In terms of dividend growth, well, we already said very attractive increase this year. Again, nice high single digit over the last 5, and over the last 20 years, they have been increasing those dividends at a double-digit rate. 20 years as well of consecutively increasing the dividend, 5 more years before they gained dividend aristocrat status, and they've been paying a dividend for the last 34 years without a reduction. Then we get into our first valuation model. Do bear in mind though, we're not looking at any of these in isolation. We will ultimately conclude when we come towards the end of each company. Now the blue tunnel is the expected fair price. Right now we sit in the mid to lower end, so you could argue around reasonable valuation from this model. Then we get to dividend yield theory. This tells us a company is undervalued when the yield sits above the 5-year average, marginally higher, so slight undervaluation. The forward P, however, undervaluation signal is when it is below the 5-year rolling. This isn't too far off, so this could be reasonable signal. Then when we take a look at the sector P, industrials is higher at 21.3, so Northrop Grumman is currently trading at a discount to the overall sector. Then we jump onto our first metric here below, which is the free cash flow payout. As always on this channel, free cash flow over earnings, which is susceptible to manipulation by management through accounting, and we use a threshold maximum 60%, because that does ultimately give us faith management can offer nice increases like we have seen from NOC. Now below 60 is what we get every year bar 2022. Nice to see from then it is starting to come down. 47 on a trailing 12 month, 37 over the next 12 months. So this is a good sign that those increases that we do love to see from this company should continue. Then we get to the free cash flow per share, where we want consistent increases over the longer term. This isn't something we get in terms of the consistency. Nonetheless, it has increased over the last 10 and is expected to increase massively over the next 12 months to $22.50 per share. In terms of sales growth, we want to see 3 to 7%, in fact 3 to 4 just to keep up in line with inflation. A little bit inconsistent, but nice to see over the last year and on a trailing 12 month, they are increasing it above that inflationary rate. And when we do zoom out, we can see around 80% growth over the last 10 years. And what they've also done at a fairly small and consistent rate are share buybacks, reducing those shares outstanding. What this ultimately means is that companies are returning excess cash to shareholders as the portion of the company they own does increase. ROIC, one of our favored metrics, 10% or more, give us faith management are able to effectively allocate their capital. This company looks very strong with regards to ROIC, a little bit inconsistent, and we do notice a drop into the more recent year, but from a historic perspective, it does look decent. Then we move on to the operating margin. Two things we want to see here. Firstly, we want to see a minimum 12%. We get that straddling year on year, although it did dip in the more recent period, 2023. Second thing we want to note are efficiencies, where margin has increased in line with revenue. This isn't something we get from NOC currently. And the second thing is the free cash flow margin at a bare minimum 5%. That is again something we can see straddling at that point on a year-on-year basis. Then we move on to net debt to EBITDA, another metric we like in conjunction with the ROIC. EBITDA referring to the earnings before interest, tax, depreciation, amortization. Below 3 is what we want to see. Now remember, this correlates to dividend safety, balance sheet strength, and the numbers you see below are the number of years it would take the company to pay off all of their debt net of cash on hand. Now it was very high in 2018 at 4.26. What we like though, since then it has started to come down, 2.26 in 2023, 2.34 over the next 12 months. So it isn't too far off that 3 that we want to see as a maximum, something just to bear in mind, and maybe to add a little bit more margin of safety in the valuation that we are about to take a look at now. So let's get into the valuation. As always, if you do enjoy the content, value is being provided, smash that like button, hit that subscribe and bell button so you are notified of these videos as they drop. Now, when we do our deep dives on companies on this channel, we run through every single one of these models. We talk about the inputs and the outputs that we use. Today, we're going to get straight to it. We are going through 7 stocks. And the intrinsic value for this company, $590, which is the average of these models that you can see on the screen. We always like to look at a margin of safety where we start with 10%, execute on that if it meets our 3 golden criteria: wide moat, strong financial metrics, good forward-looking data. If you believe that in today's episode for NOC will buy up to $531, then we keep going till it's near the current trading price, and it's not at the 20% level just yet. That would be $472, but up to around $500, you are getting at least a 15%. So between 15 to 20 in today's episode, with Wall Street having a price target of $600, their upside is 22% over the next year. And as always, do give us your thoughts below. Maybe this is one on your radar, maybe this is one you've been buying, or for whatever particular reason, if it isn't one for your portfolio or you are considering selling, do give us your thoughts below. Now, today's video is sponsored by Snowball Analytic, which is a fantastic portfolio tracker that every investor needs, and it is one that we like and use ourselves. You can currently get a 14-day free trial and a very good Black Friday deal that definitely shouldn't be missed. Bear in mind, this is a dummy portfolio, but the user interface is very easy. We do like the way this is split out in terms of the different sectors that you can see, for example, what your allocation is. The game that you have makes you understand whether or not you want to continue adding to any position depending on the allocation you want for that overall sector. We also like the way that if you want to take a look at your yield, you can also see your yield on cost. So this portfolio, while the yield may not look high at 1.5%, your actual yield on cost is very, very high, and you get to see a breakdown of each of your companies and the overall allocation to your portfolio in terms of the dividend weighting. And we quite like to see a dividend score. For example, Nvidia 100, no surprises, something we have talked about quite a lot. And then we get to Ultra, the company that does pay a very high yield, currently sitting at 43. Other things which are quite unique to this platform we haven't seen before, you can compare how your performance is doing to the overall S&P 500, which is very important, especially if you are someone that does want to pick individual stocks. For example, we can see the S&P 500 has outperformed this dummy portfolio just over the last year by around 30%. You can also take a look at your portfolio in terms of the dividend, how much you are going to be paid out on a monthly basis. So we can see if you were a shareholder of Realty Income, you would have been paid out on the 15th of this month. And you can also consider when looking at new companies to add when their dividend is going to be paid. For example, if we take a look at the month of November, we can see when companies do pay out. If you look at your portfolio and you see that in the month of December you aren't getting as much dividends as you want more dividend paying companies, you can just come take a look, and we can see here that CVX are paying out a dividend, and then take a further look. You can also look at companies in a bit more detail. For example, here we have Johnson & Johnson. We can see a lot of statistics here. We can also focus on the dividend element. What is the yield? What is their payout? Their growth over the last few years? What is their dividend streak? As well as looking at the numbers behind the company. For example, the income statement, the growth that can be seen over the last 10 years. We can also factor in the statistics, something that I quite like to see. So for example, 10 years ago, their payout ratio was sitting around 48%. In 2023, it did come down to around 33. As we said, 14-day free trial as well as an excellent Black Friday deal. So do click on the pinned comment below, sign up and take advantage while you can. We then move on to the next company, which is Novo Nordisk, one we have talked about for quite some time. We just get one buy rating from Wall Street, although Seeking Alpha with their hold at 3.4 isn't far off the 3.5 to flip it to a buy. We can see Quant though firmly at the hold. As we know, it is towards the lower end of the 52-week range. The forward yield sits at 1.4%, the forward P at 33.4, and over the last 12 months, it is up only 4%, underperforming the S&P, although over the last 10 years, up 358, massive outperformance. And bear in mind, if you do reinvest those dividends, you would be up even higher. In terms of their EPS growth, over the last 3 quarters, they've beaten 2 of the 3. Their more recent quarter was actually a miss by around 7 cents. But what is nice to see, over the next 2, Q3, Q4 of 24, they are anticipating double-digit growth to the EPS. And ultimately, for their full year of December 2025 accounts, earnings per share is expected to grow, there in turn lowering the forward P to 27.77. Now, we do get a very safe score. We love to see that. Not only that, it is a 99, the highest score obtainable, and we can see a very, very rapid dividend growth at 52% over the last full year. How did they do in the last recession? Well, they increased the dividend. They had positive growth. Remember, the S&P was negative 12, and they also massively outperformed the S&P, still negative 27%, but the S&P, as we said, was negative 55. Dividend growth, something that every investor will love to see, double digit across every single period, including on average year on year over the last 20, and they're also a dividend aristocrat with 25 plus years of increasing the dividend. When we get to the first valuation model and zoom in into the last 12 months, we notice for the first time in a while it is trading just outside that blue tunnel, or just inside. That is an undervaluation signal. And then when we take a look at dividend yield theory, we can see the yield is marginally lower than the 5-year rolling, that is a reasonable signal. However, the forward P at 28 is lower than the 5-year of 30.4. In terms of the sector comparison though, we do notice Novo Nordisk is trading at a premium, and a question that we do need to ask when looking at companies: are they worthy of a premium? The likely answer in this case is yes, but then the follow-up to that is how much of a premium does it deserve? And that is what we try to answer by looking at our valuation process. In terms of free cash flow payout, below 60% is what we want. It does look a little bit inconsistent in that. Nice to see though, in the more recent year and over the next 12 months, it is anticipated to come to around 52%. Free cash flow margin looking good, tripled over the last 10 years. Not as consistent as we would like, but moving in the right direction. Over the next 12 months, a nice jump to just under $20 per share. Sales growth, more often than not, very good. Double digit just over the last 3 years. Double digit over the last 12 months. So we do anticipate 2024 to be a very good year for NVO. And then for those that want to see it on a more numerical basis, nearly 3 times growth over the last 10 years, whilst also doing share buybacks on a year-on-year basis. Nice and consistent, in line with that double-digit increase, making it a dividend growth investor's dream. In terms of ROIC, you will struggle to find one that is nearly as strong as this company, well above the 10% minimum, 72 in 23, 64 on a trailing 12-month basis. We also get marginal operating efficiencies, 39% in 2014, 45 in 2023, well above the minimum we want to see, and the same to be said on the free cash flow. Definitely a free cash flow machine, one we definitely do like. On top of that, just look at the net debt to EBITDA. Below 3 is what we want. Over the last 12 months and over the next 12 months, it won't even take Novo Nordisk 1 day to pay off all of their debt, net of cash on hand. A very, very strong balance sheet indeed. Now our intrinsic value, $134. We'll show you how we got this for this company, just given its one model, the DCF. We effectively have the free cash flow year on year, the average growth rate at 11%. Now we've gone 16% in today's episode, in line with what management are targeting moving forwards. And then essentially with the discount rate, we have the present value of future free cash flow and terminal value, add together with the cash, subtract total debt, get to the equity value, divide by the shares outstanding, and as we can see, 134 indicating 26% upside. Now remember, you can grab a copy of this model by clicking on the pinned comment below, running through your own numbers, whether it is for NVO or any others. But full transparency will show you here at 14%, an intrinsic value of 116, indicating 10% upside, and at the 18% point, we can see 154, indicating 45. As we said though, we will take that management estimate of 16%, and when we do look at the MOS in today's episode, and we keep going to near the current trading price, you're looking at 20% for what we do believe to be a high quality company. Wall Street, on the other hand, they believe the price is going to $155. They see upside of 46%, definitely making it one you should consider in their eyes. As always though, do give us your thoughts as we go along today. We also want to let you know we have just released our latest free weekly article where we go through 2 beaten down stocks with over 30% upside. We released one every single Monday morning to your inbox where we highlight severely undervalued stocks that deserve your attention, as well as what's gone on in the market over the last few days. So click below, you can sign up and read straight away. On top of that, tomorrow morning we are releasing December's version of the undervalued stocks for the month. That is 28, where we look at a lot of information for each one, as well as the upside that Wall Street themselves see over the next year. And on top of that, you can grab a recently released spreadsheet that looks at 29 undervalued dividend stocks that Wall Street themselves believe have the most upside right now in the S&P 500. So click below, you can sign up and start reading straight away. The next stock we're looking at is Mondelez, where we have a strong buy from Wall Street, a buy from Quant with a hold from Seeking Alpha. This one is trading right there towards its 52-week lows with a yield of 2.9%, a forward PE of 18.6, and over the last year, down around 8%. The rise in cocoa prices, like Hershey, has hurt Mondelez overall, and over the last 10 years, it is up around 69%. In terms of their growth, while moving forwards over the next 4 quarters, they are expecting challenging times to continue, decrease therefore for each quarter to the EPS. However, historically, 100% track record, management do typically beat what the analyst predicts, and over the next full year they are expecting no growth to the EPS, in fact a very marginal decrease, and that is why we see a very marginal increase to the forward P anticipated. We then get a 66 safe dividend score, an undervaluation on dividend yield, reasonable valuation here, with a very strong 11% increase to the dividend in August this year. In terms of dividend safety, what a safe score ultimately means is that a dividend cut is unlikely, and the last recession they maintained the dividend, didn't increase, didn't cut. They had below average growth whilst also marginally outperforming the S&P -35. And nice to see double-digit increase is something they have done historically over the last 5 years. However, over the last 20, it does drop down to around 5%, with 10 years of consecutively increasing that dividend. Then we take a look at this valuation, which is based on the forward P. Over the last 12 months, pretty much straddling inside the blue tunnel. Right now, though, it does sit towards the lower end. And when we get to dividend yield theory, massive undervaluation signal. 2.89, that is the highest yield they've offered over the last 5 years. 2.27 is the average, with also another undervaluation on the forward P, 19.8, below the 5-year rolling of 20.9. We can also see it is marginally higher than the consumer staples sector of 18.8. In terms of looking at the free cash flow, below 70% for consumer staples, something we pretty much see on a year-on-year basis. 57 over the next 12 months does also look fine. Then we get to the free cash flow, more than doubled over the last 10 years. A little bit of inconsistency, but it does look fine overall. Nice jump expected to 332 over the next 12 months. We then move on to sales growth, where we see very mixed, but looking much better over the last few years. 2% on a trailing 12 months, so we are anticipating a substantial drop from the previous year. And when we do look at it from a numerical perspective, we can see there has been periods where it has struggled over the last 10. Nonetheless, they have done share buybacks, as we can clearly see over the same period. Some years a lot more than others, but ultimately it is still part of management and their capital allocation. ROIC, we want above 12% for consumer staples, not something we see consistently. In fact, only really getting the 12% in 2023. Nice to see that reinforced on a trailing 12-month basis. And then when we get to margins, we do know operating efficiencies. It has been increasing 12% to 17% in 2023. Ideally, we do want to see this continue to rise in line with the increases that we want to see to the top line revenue. Free cash flow margin looking very healthy as well, especially since 2018. And then we get to the net debt to EBITDA, which we do like, given the fact for consumer staples we want to see below 4. It has been decreasing from the highs of 2017, 2.33 2023, 2.19 over the trailing 12 month, so well below that 4. Balance sheet looks good at a very high level, as well as that dividend safety. In terms of the valuation, well, our intrinsic value at $81, pretty much where Wall Street see it over the next year at 25% upside. And when we do run it through the calculation today, we effectively see with Mondelez 20% MOS, with Wall Street, as mentioned, 25% upside. Let us know if you see this as a buy, hold, or sell. We then move on to Merck & Co, where we get a double buy rating and a hold from Quant. This one is trading towards its 52-week lows, similar to Mondelez, with a yield of 3.14%, a forward P of 13.3. Over the last year, pretty much unchanged. Over the last 10 years, up around 68%. Remember, dividends reinvested will take this higher. And when we look moving forwards, always love to see green across the board. In fact, over the next 4 quarters, very large growth anticipated. And at a bare minimum, over the last 4 quarters, they have in fact either been in line or outperformed. Nice to note as well, next 4-year annual accounts, massive jump to the EPS. There in turn, lowering forward P to 10.87. Dividend safety, well, we have got quite a few very safe scores today, which is great to see. And they did increase the dividend just this month around the inflationary rate at 5.2%. In terms of how they performed in the last recession, while they maintained the dividend, they had negative 4% growth whilst also having a near S&P return. In terms of longer term dividend growth, well, 9% over the last 5 years, and at a bare minimum over the last 20, they've been increasing it in line with that 4% inflation. In terms of dividend growth, well, 12 years of consecutive increases, but we do note they have been paying a dividend for the last 53 years without a reduction. Then we get to essentially looking at this valuation, where as we know, just over the last few weeks, it has come right there towards the lower end of the reasonable target. And when we do get to dividend yield theory as well as the forward P, both signs of severe undervaluation. We also notice that this company is trading at quite a substantial discount to the overall healthcare sector. In terms of looking at the free cash flow payout, well, below 60% isn't what we get on a consistent basis. 81 in 2023, a little bit too high for our liking. Good to see on a trailing 12 month and over the next 12 months, it is coming down. We then move on to free cash flow per share. We do get growth, but again, we get inconsistency. It is quite interesting to note that from the majority of companies that we do review on this channel, there aren't that many that have a lot of consistency on the free cash flow. But good point to note, expected to more than double to 824 over the next 12 months. We then look at sales growth, where 3 of the last 10 years have been negative, 1% in 2023, that is lower than inflation, but good to report on a trailing 12 month at 7%. We do anticipate 2024 to be a strong year for this company, with around 50% growth from 2014 to 2023. They've also done share buybacks, a little bit more inconsistent than we would like, and in fact, over the last few years, hasn't really moved. Therefore, unlike some of the companies today, it doesn't look like it is part of management and their capital allocation. ROIC, very strong, well above the minimum 10%, and it has been increasing. Nice to note, 23% on a trailing 12 month. And the operating margin, we do get to see those very nice efficiencies increasing over the longer term, and the free cash flow, whilst inconsistent, looking very, very healthy. Finally, the net debt to EBITDA, bit scary when we do take a look at that 2023, the massive jump, but very nice to note on the trailing 12 month, it has come down substantially and expected to come down even further over the next 12 months, which is why we ultimately get that very safe dividend score, and balance sheet again, high level, does look to be good. Then we get to the valuation, $132. Wall Street see 133, so pretty much in line. They see 31% upside over the next 12 months. And when we look at the MOS in today's episode, you are pretty much getting around a 25% at the $99 mark. Not far off there. 25% MOS, 31% upside. Does look like a good contender to consider for the portfolio, but do let us know what your thoughts are about Merck & Co. We then move on to General Dynamics Corporation with a double buy from Seeking Alpha on Wall Street, a hold from Quant. This one is trading in the midpoint of the 52-week range, a forward yield of 2%, a forward P of 20. Over the last year, it is up 16%, but has underperformed the S&P over the last 10 years, up around 97%. When we look forwards, the next 4 quarters, they are expecting double-digit growth to the EPS. But I think for the first time, unless I'm mistaken, on this channel, we are seeing a company that over the last 4 quarters has missed every single one, giving them, in fact, a 0% track record in hitting their targets. Having said that, if you do still believe they can hit what they are saying for the next 4 quarters in terms of their EPS, then the forward P is expected to come down to 17.5. We get yet another very safe dividend score at 97, where we do also note a fairly strong dividend increase at 7.6% in March this year. In terms of the metrics, while they increased the dividend, they had above average growth and pretty much an inline recession return, negative 57%. Nice dividend growth, no real complaints, 11% on average over the last 20 years. And we also notice here they are a dividend aristocrat with 32 years of consecutively increasing that dividend. In terms of the valuation based on the forward P, we actually note this company does look like it has been trading overvalued for a little bit of this year. Right now, though, it is firmly within the blue tunnel. That is that reasonable valuation signal. And when we get to dividend yield theory and when we look at the forward P, we do notice a little bit of overvaluation on both of these. And when we get to the industrials as a whole, it does look to be trading at a discount. Lots of different signals, which is always why we like to conclude when we do get to our own valuation towards the end. No real issues with the free cash flow. 38 in 2023, expected to come down to 35 over the next 12 months, which is very, very healthy. And then we get to the free cash flow per share, where we do notice increases over longer term. But as we have seen with many companies, inconsistency, nice to report an increase is expected over the next 12 months. In terms of sales growth, a little bit more inconsistency. Last year looked fairly strong, trailing 12 month also looking good at double digits. And when we look at the total sales, we do see growth, maybe not as strong as we want to see, but bear in mind we do need to consider the industries that we are analysing. Some industries, like tech, are expected to grow a lot faster than others. Shares outstanding, well, they have also done share buybacks on a consistent basis, not as much as maybe we would like to see. Nonetheless, always like to see it as an added bonus on top of a dividend paying company with some very nice increases. ROIC, yes, it has been decreasing over the last 10 years, but we still see very good numbers even over the last few, and 13% on a trailing 12 month isn't anything we do need to flag. In terms of the margins, we're straddling around 12% on a year-on-year basis, although we can see a bit of a dip. No real concerns as of yet, something we can keep our eye on, and no issues whatsoever on the free cash flow margin at a bare minimum around that 5% level. We do quite like to see this with companies. Yes, they do get very high at 3.12 on the net debt to EBITDA, but year on year it is coming down, and this goes to show us that management, as part of their capital allocation, are looking to delever the balance sheet, pay off a lot of debt, and 1.84 on a trailing 12 month expected to go lower over the next 12 is a good sign, and no worries, no surprises too at that very safe score. Our intrinsic value 362 at a 10% MOS, a buy at 327, and as we do keep going in today's episode, we can see up to $290, 20% MOS, with Wall Street indicating $340 price target, 20% upside. We then move on to Evolution, where it is trading at its 52-week low, and in fact, Seeking Alpha give this a strong buy. Now, it is down nearly 20% over the last year. Over the last 5 years, though, it has massively outperformed the S&P, up 228%. Now, we don't have a dividend safety score just yet, but we can see their dividend increase was very strong over the last full year at 33%. In fact, they have typically increased the dividend at some very, very attractive rates, 53% year on year over the last 10. And then when we do take a look at the metrics, the free cash flow has consistently over the last few years been below 60%, 49 on a trailing 12 month, 48 over the next 12. And we can also see some very, very strong free cash flow growth, 5 cents in 2014, $5 in 2023, and expected to continue to climb over the next 12 months. We also notice, whilst you could argue a slowdown in terms of their top line growth, that we still get to see double digit year on year, 19% on a trailing 12 month, and we can just see some phenomenal growth. 5 million they reported top line revenue 2014, 2023 1.8 billion. They have, however, diluted your position as a shareholder over the last 10 years, something just to factor in. ROIC, no real issues. We do see a large drop during the COVID year, but since then it has started to climb back up, like this 33% on the trailing 12 month. And the operating margin, love to see these very, very obvious operating efficiencies, and the free cash flow looking very, very good. Lots of positivity about this company, and we did also get a fairly rare strong buy rating from Seeking Alpha. Net debt to EBITDA, 0 across the board, not even 1 day for this company to pay off all of their debt net of cash on hand. Now, our intrinsic value at $128 in today's episode is going to give perhaps the largest margin of safety today, and up to $89, $90, you are getting a 30% MOS. For 35, you would have to wait for 83. 30% MOS, 60% upside from Wall Street at $140 price target. Maybe this is a company you have looked at before. As always, do give us your thoughts below. We then move on to Occidental Petroleum with a triple hold across the board. This one, again, similar to others today, is trading towards its 52-week low. A yield of 1.8%, a forward P of 15. Now, over the last year, it is down 16%. Over the last 10 years, in fact, down 38%. But bear in mind that will depend at which point you bought. If you got it at the COVID lows at $10, you would in fact be up more than 5 times today. In terms of earnings, well, this industry is cyclical, and we do note 2 of the next 4 quarters are expected to be a decrease, but a 100% track record for management in terms of hitting and bypassing the estimates from Wall Street. We can also see growth expected over the next full year, there in turn lowering the forward P to 13.83. Now, they do have a borderline safe score, so we can touch upon that, but we did get a very attractive double-digit increase in December last year, meaning over the next few days, we are anticipating another increase for Occidental Petroleum in 2024. Now, it was literally just reaffirmed last week, this score, which means that there is a moderate risk of a dividend cut over a full economic cycle. In terms of how they performed in the last recession, well, they increased the dividend below average growth whilst massively outperforming with a negative 23% return. Now we can see they have had a dividend cut noted by the negative 25% per year over the last 5, and they've only increased the dividend at 2% over the last 20. Hence why we can see here, in fact today, just 2 years of consecutively increasing the dividend. When we take a look at the forward P ratio, well, in fact, we can see right now this does look like severe overvaluation, as it is above even the upper end of that blue tunnel. And when we get to dividend yield theory, this is actually a severe undervaluation signal, 1.74, well above the 5-year of 0.88. And we do notice the forward P giving us the opposite. This is an overvaluation signal, with in fact it trading right around the energy sector of 15.9. So lots of different signals going on with Occidental Petroleum. And when we do get to the free cash flow payout for oil producers below 40%, something we have seen over the last few years, and over the next 12 months, 19%, not giving us any issues so far. Free cash flow payout does look very cyclical, as we can see, some years negative, some years very high increase followed by a decrease. Over the next 12 months, it is expected to come down to 467. Cyclicality showing through their top line revenue, in fact 5 of the last 10 years negative, notably 2023 and expected 2024 based on the negative 7% on a trailing 12 month, and you can see the numerical format below. In terms of shares outstanding, well, they have diluted your position over the longer term, but we can see from 2022, where it was at 1 billion, they have slowly started to do share buybacks. Maybe this is something management are considering if they see the company right now as severely undervalued. ROIC, we don't get the consistency, but we typically don't anyway in this industry. So we do like that over the last few years, it has been fairly decent. Nice to see that 8% on a trailing 12 month, but as always, we do want to see that 10% at a minimum. Margins, again, looking very inconsistent on both sides. What we do notice, though, over the last few years, it has looked positive, something that we do want to see on a more consistent basis. Net debt to EBITDA below 1.5, well, 1.71 is what we see over the last 12, which does go some way to explaining that borderline safe dividend score. Over the next 12 months, a small drop is expected, something to keep an eye on, as we do see a lot of fluctuations with their debt levels. Now, jumping into the valuation, our intrinsic value of $64 is pretty much in line with Wall Street at $64.2, where they see 27% upside over the next year. In terms of our MOS today, well, for Occidental Petroleum, up to around $51, $52, we do see it at 20%, with Wall Street, as we said, 27% to the upside. As always, if you do enjoy the content, value has been provided, smash that like button, hit that subscribe and bell button so you are notified of these videos as they drop. Don't forget to sign up to the free weekly newsletter. We are dropping a new copy on Monday morning, and come and join us in the Patreon where we are talking about our weekly buys and sells. As always, have a great day, and we'll see you all on the next one.